So good morning, Florian and co. So shall we just jump straight into it?
Yeah, I would say we can go.
Okay, so just to remind you all, Geodrill is a leading exploration drilling company with operations in 2 continents and 6 countries. They are namely Ghana, Burkina Faso, Ivory Coast, Mali in West Africa, and Egypt in North Africa, and we have Peru in South America. So what's topical at the moment is that on Monday, the company reported its fiscal 2021 and its quarter 4. So we're going to jump straight into those slides. I'm not sure if you want to jump to the financial side or just the background of the company. Maybe I'll just quickly go through the background slide. So I founded the company 25 years ago. We quickly went about establishing ourselves as a formidable drilling company. It was a very different market back then. The big corporate drillers were sending their old worn out rigs to Africa. I looked at this a little differently and I thought to myself, well, if this is going to be my primary market, then better I send modern high performance equipment. So from the get-go, it's been our mission statement has been one of quality and quantity, and also listening to our customers' needs. So we pride ourselves on providing the full gamut of exploration drilling services, and we do this with a modern high-performance fleet of drilling rigs, and also by providing our customers with solutions such as providing a multi-purpose drill. A multi-purpose drill is a drill that drills both reverse circulation and core drilling, and that's an easy sell, and it makes these rigs very versatile. And the advantage of this is that they're highly utilised in all stages of the market, whether the market's in a down cycle or an up cycle, the rigs are always busy. That's pretty much the genesis of the history of the background of this company. This is a map that basically shows where we operate. Way back at inception, the thing I found interesting about Africa, and particularly West Africa, was that the region had missed many decades of modern exploration. And that was 25 years ago. And nowadays, West Africa is actually becoming a very mature market, demonstrated by the leading names that have now flocked to West Africa. All the big guys are out here. We've got Newmont, we've got Barrick, we've got Kinross, we've got Anglo Gold. Pretty much anyone who's anyone is in West Africa. So the point that I'm making here is that anybody that's not operating in West Africa is missing a substantial piece of the exploration and drilling pie. So basically jumping to the financials, we capped off fiscal 2021 with outstanding momentum, delivering on all key financial metrics and strengthening our balance sheet. We generated record revenues of $115 million USD. That is a 40% year-over-year increase compared to 2020. We also generated record EBITDA, $29.5 million USD. That's a 26% year-over-year increase. Excuse me, that's a 26% of revenue and a 55% year-over-year increase. And we also recorded net income of $14 million USD, and that was a 88% year-over-year increase. And as a result of these 3 record beats, we achieved for our investors a return on capital employed of 22% and a return on equity of 16%. Now that's up from 14% and 10% a year ago. Geodrill's balance sheet also strengthened. We increased our net tangible book value by 18%, and our total shareholder equity increased to $87.5 million USD. That's up 20% year over year. We ended the year with $2.4 million USD in cash, and that was after decreasing our debt by $3.4 million. And during the year, we delivered a 2-cent Canadian dividend. So the bottom line is that our strong balance sheet positions us very well as we move forward into this evidently just arrived upcycle. During 2021, we strengthened the business by reporting stellar health and safety LTI numbers. We did 5.4 million hours LTI free. We recorded average rig utilization throughout the year of 70 We peaked at about 70 and we bottomed out at about 61, but on average, we averaged for the year 70%. We also successfully expanded into new markets, being Egypt and Peru. And we capped off the year by signing 3 very significant new contracts totaling $130 million USD with top tier names. We expanded our rig fleet to 71 drills to support our key operations. And we increased utilization. And as utilization increased, we started to see towards the latter part of last year some interesting pricing leverage. So our focus on delivering steady revenue growth, strong net earnings, and a strong balance sheet really has enabled Geodrill to invest in key growth opportunities. And this has resulted in us growing our rig fleet count since inception at a CAGR of 20%. So that's pretty much the Geodrill story. In conclusion, we believe that there are catalysts that are going to make the next few years quite interesting. The cycle is turning, and Geodrill will benefit from improved gold markets and sector rotation. We're now seeing the benefit of diligent growth decisions that we took through the cycles by increasing our rig fleet, even in the down market, as I said. We're expanding into high growth markets, Egypt and Peru. So our long-term outlook is very positive, with increased utilization driving free cash flow and expansion initiatives. Valuation-wise, the stock has done pretty well, it's fair to say, in recent times, up 30% since the start of the year. But to be fair, our revenue has also increased 40%, EBITDA is up 55%, and net income up 88%. In fact, over the last 3 years, on average, our earnings per share has increased by 77%, but our share price has only increased by 22%. So in relative terms, we're actually as cheap as we have ever been. That's it pretty much. That's the Geodrill story. Great business in the right geographies, and with great prospects for growth.
Excellent. Thank you very much for the quick overview. I was going to ask about your contract book. Is there something like an average duration or a certain percentage that basically has to be replenished in contracts every year?
We're a contracting business, so we're actually working for contracts all the time. As one contract finishes, another one, as one ends, another one begins. And I think what's significant with these 3 contracts that we've recently announced is the fact that we don't normally announce contracts unless they are significant. Anything over $20 million we consider significant. As these contracts end, they'll be replaced with new contracts. The 3 contracts that we have mentioned are not our only 3 contracts. We probably have 20 or 30 different contracts going on at the moment. And we're a contracting firm, and so by the nature of our business, we work to contracts. Essentially, if you take the contract out of the discussion, out of the narrative, what we are essentially is a service business. We have customers that have a requirement to drill. We provide a drilling service. Our customers need to drill. We have a drilling service. It's pretty simple. We have a contract, and therefore we are contractors. But what this business has really been about, as you might have picked up in about slide 2 or 3, it's about providing a service. Customers have money to spend on drilling, and they are spoiled for choices as to where they can spend that money. Yet somehow or another, Geodrill has grown organically from 1 rig in 1998 to where we are today, 71 rigs, and we're adding 7 rigs this year. We will close this year closer to 80 rigs. We'll probably add about a similar amount next year. Slowly but surely, we're going to keep forging to probably north of 100 rigs. Revenues will continue to grow. Margins will continue to grow, and net income will continue to grow. But we don't dwell on contracts, to answer your question. I'm sorry for that long-winded digression. We don't normally get too concerned about contracts. We just really focus on keeping the rigs busy.
And in terms of pricing, can you talk a little bit about how the pricing works for your contracts?
So each job that we bid, we look at it and say, well, we really need to be building a model around this job so that we can make a gross margin of about 27 to 28%. And if we can't make 27 to 28%, we leave it for one of our competitors. We're not interested in subsidizing our customers' drilling programs. And that's pretty much something that we've been very disciplined about throughout the years.
And how does it then, so let's say you announced recently a contract over 5 years. Is that at a fixed cost, or is that cost plus? Because obviously you don't know now what your whatever fuel costs or transportation costs will be in 5 years.
No, but I know what my costs will be today, and as we move forward, anything over 12 months, we automatically build a rise and fall formula in, which protects us against things that move. Like, for instance, what's moving at the moment is fuel, the cost of air freighting, the cost of sea freighting, salaries are going up. All these things will be captured as we go down. We end our first year. We build a formula. We basically key in all the indices, and at the end of the day, the formula spits out an answer, and we would put in a one-off adjustment invoice to cover the rise and fall. It's a pretty standard procedure with anything over 12 months.
And so it's basically you lock in your pricing for a year, and then basically next year you reconsider, even though it's a fixed contract, the pricing will change along with costs. Okay.
Correct. The only variable in the 5-year or 2-year or 3-year term is the fact that we will have a rise and fall formula, and most customers would accept this because they understand that we don't have a crystal ball. We don't know what our costs are going to be in a year's time. So it's a pretty standard procedure in contracting. Anything over 12 months is generally subject to a rise and fall.
Perfect. Well, what is typically more important for your customers? Is it strictly on pricing? Is it on how quick you do the job, or your diligence, or what would you say is the most important aspect?
Well, price is obviously a very significant determinant, but not the only determinant. There are things like I mentioned, our health and safety figures. This is a huge part of, no mining company is going to give a drilling contractor the job because they're cheaper if they're not going to be able to operate to the highest international health and safety standards, because if there's an accident in a mine, then it's the mine's reputation that suffers. It's the same with environmental damage. And so ESG is becoming a huge part of what we do. Geodrill is actually leading the way out here in West Africa with its ESG agenda. We're actually one of the highest rated ESG, have one of the highest rated ESG profiles in the industry as we currently speak. And this is all very important when we're bidding jobs with customers like Barrick and Newmont and Anglo Gold. The ability to be able to do the job, efficiently and diligently. Where Geodrill has really excelled, I believe, is that we've become very committed to the region. We don't try and operate this business from Salt Lake City or from, Moncton in Canada or from Perth in Australia. Where I'm speaking to you from today is Ghana, West Africa. This is where I live. This is where I run the business from. This is where I run the business from for 25 years. And I believe this is a large part of why we're successful. Tomorrow morning, I'll be on a plane to Kumasi. I'll be able to visit my rigs, walk through my workshop, visit the engineering facility, take a stroll through the training academy where we're training, new drilling talent. This is not how drilling companies normally operate in Africa. Normally, drilling companies, even the big ones, Port Longyear, Major Drilling, they come to Africa and operate out of a 40-foot container. We don't do that. You know, if you quickly visit our website, you'll see that we have built a network of support facilities spanning Ghana, which is our beachhead, Ivory Coast, where we're building a 10-acre facility, which is smaller than the facility that we have in Ghana. But there's no drilling company in the world that has our sort of infrastructure. Not a drilling company in the world. Rigs break down. That's the reality. But in West Africa, if you break down and you don't have the support facilities, then you'll be waiting for a long time to get your drills going. Now, customers don't want that. Customers want to drill their programs as efficiently as they possibly can. So they want a no-nonsense drilling company that can deliver the goods at a very competitive average cost per meter with all of the international boxes being ticked. And Geodrill does that. It has done it consistently for 25 years. And this is why our business keeps growing and growing.
So I assume that network that you have built up over the years will be quite valuable for a bigger drilling company as well. Is that correct?
Oh, look, I do think a lot of the other drilling companies are quite envious of what we've built over here. I do believe that there would be, you know, as we've, you know, broken through the $100 million barrier, we've popped up on a lot more radars. We've certainly garnered the attention of a lot more investors and also other drillers. You know, we're constantly fielding inquiries from other drillers that want to potentially do something with us. We have on average about 2 or 3 of those conversations a year. And I think eventually one of those conversations is going to end up in a deal that will be inked. I have no desire at all to die with my boots on, I can assure you. I'm 64 and I want to be out of this business probably in the next 3 to 5 years. Now we're just entering, it's interesting because we're now entering a upcycle. I don't have a crystal ball. I don't know how long it's going to be, but what we know is the down cycle was 7 years. And generally speaking, in this business, the up cycles mirror the down cycles either side of the parabolic, if that makes sense. And so what we can say with some confidence is that we are now in an upcycle. How long will the upcycle last? Probably 5 years, maybe 7. Certainly not less than 5. When did it start? About 2 quarters ago, I believe, probably 3. And so what I think is going to happen is you're going to see a little bit more corporate activity. You're going to find companies will be changing the exchanges that they're trading on. You'll find, you know, I think you're going to see a lot more M&A in this business. And even in the down cycle, we're fielding inquiries about M&A. Didn't really end up doing any deals because we were trading at a 3 times multiple. We aren't going to do no deals at 3 times multiple. Let me tell you. This thing will go out the gate at probably 4.5 or 5 times to someone. I don't know who, but I just know that that's the number.
In terms of your growth rates and drill rigs, is there any bigger bottleneck in terms of adding rigs, adding business?
Well, as I mentioned, we're adding 7 drills this year. 5 of them are going to Egypt and 2 are going into our normal market here in West Africa. That's pretty good growth for 1 year. I mean, we're a 71 rig operation and we're adding 7 rigs. That's 10% organic rig fleet expansion. I think that's, you know, I don't think there'll be too many companies out there doing that. We will probably do as we continue to as time marches on and we go deeper into this upcycle. I believe we will keep doing what we've always done, which is invest our cash from operations back into the rig fleet. And I'll just jump back to that slide and show you how well it's worked for us. There it is there. Since day one, 1998, first rig. Once we paid down our debt, we started this company 100% levered. 100% levered. I spent a couple of years paying down the debt, and then I was spitting out. Back then, I was, you know, obviously didn't have the G&A costs that I've got today, but we were essentially adding a new rig every couple of years, and then it was every 3 years, we'd add another 5 rigs and then 10 rigs and so on and so forth until we reached about 20 rigs. And that was 2010, and then we went public. You can see what's happened since 2010. Where's 2010? Well, there's my cursor. We had 18 rigs. And you can see that growth has been phenomenal since, being able to access the capital markets. But I'll just hasten to add that was the only raise we ever did that put money back into the business. It also provided a secondary for me to take some money out so that I could sell down my 60% in the business. I still own 40% today. As a result of those funds coming in and some debt we took on along the way, we've grown the rig fleet to 71 rigs. It's been phenomenal. And the revenues back when we went public were $45 million, and now we're north of 100. This year, we're programming that we will conservatively achieve about $100 to $132 million. I think that's where analysts have got us, and I'm very comfortable with that. And from there, going forward, I believe you could work on 10 to 15% growth year over year. So if you pull out your calculator and you plug in 115, add call it 12.5%, 13%, you're going to end up at about 132 million. Add another 12.5%, and another 12.5%, another 12.5%, and you'll realise that when you get to 5 years, we're at $200 million or just north of. And that's where I think we'll be. And that'll be very conservative. The trick will be maintaining that margin. Generally, as revenues increase and rig fleets increase, efficiencies are lost. One thing that we've managed to do, we've been very disciplined about, is growing that revenue and at the same time growing our margin, our EBITDA in lockstep with that revenue line, as well as our net earnings. And so we can say we can say with some confidence that if our revenues double, so too will our EBITDA, and so too will our net earnings.
When you are adding new rigs or just for maintenance of the current fleet, how much does that cost you as a percentage maybe of EBITDA or revenue? Is that a number you have in mind?
I'm sorry, I'm speaking to you from the house at the moment. It's kind of 10 o'clock at night here. I haven't got all my numbers in front of me, but I tend to think...
well, it doesn't need to be perfect, of course. Just
I'm sorry. Can my CFO circle back to you? It's honestly, it's one of those granular numbers that I just don't follow. 10% of revenue, or 10% of revenue, 5% of revenue, something like that. So each year our capex is made up of yeah. Look, I'm sorry. We'll get back to you.
Yeah, that's all right. That's all right.
Yeah.
Do you think do you see any trends in the industry of consolidation or the opposite of more competition?
Oh no, we're seeing a lot of consolidation at the moment. And the most recent corporate development that we've seen has been a fairly successful IPO in Australia. It occurred during 2021. Company's named DDH. I think they go by that code, DDH.AX, I believe. And they went public, and they currently have a market cap of about $400 million. They do about double our revenue, about double our EBITDA, and they have a market cap of $400 million. During the last 6 months, they did an acquisition, a pretty good one. They picked up a good diamond driller, and they paid reasonable money for it. So there's deals out there getting done. I believe that will probably somewhat woo some of the other big corporates, because these things, there's a market for these things, right? And what's the easiest way to grow your business than to join forces with another business? And I think that's eventually probably where the story is going to end up. I think with a corporate driller. I guess if I was in 10 years' time, will this still be Geodrill, or 5 years' time? Probably not. Probably not. I think we'll be one of the, part of one of the big corporates, and I mean that would be a sensible, logical thing to do.
In terms of geography, where do you see your growth coming in the next sort of years?
I think that we're going to see a consolidation for us in the West African market. I believe that we will grow quickly in Egypt. That's off to a very good start. Inside of our first year of business, we've already secured a $54 million job, and we're adding 5 rigs from what was a 2-rig operation. So that's obviously impressive on a relative basis. I think we're going to see South America, Peru will take off, and that'll be a great market for us. What we like about that market is that it's not a gold market. We draw for plenty of gold. We're about 95% gold. And so we want to start pushing more the EV side of the business. We believe in the EV story. We like copper, we like zinc, we like lithium. It's currently about 5% of our business, and we believe that that could certainly grow. So I think South America is looking very interesting, and Egypt. And I think for the West African market, we're just talking about consolidation and satisfying our normal customers' needs and demands. As they grow, we'll grow with them.
Do you see any additional political risk from that?
Certainly not in South America and not in Egypt. I think if there's any political risk, it's in some of the West African countries. And I mean, that really influences our thinking in terms of where we expand and where we allocate capital to. But I think we've got a pretty good handle on that. We've been operating in West Africa for a long time. We understand the region very well. And if things are not busy in one market, they generally tend to be busy in another market. So within the 4 countries that we operate, it's a little bit like the seasonality. When we enter into the wet season in Burkina Faso, for instance, we just moved the rigs down to Ivory Coast or Burkina Faso. So we don't. Geopolitical risk is always ever present in West Africa, but it has never stopped us from drilling, ever. I don't believe we've ever stopped drilling in a coup. Apparently there's a coup on in Mali at the moment. I don't know. Apparently there is, if you turn the news on. Well, there was, and I wouldn't know, because we're just drilling. We're just drilling. We never stop drilling. Governments don't tend to shut down their mines. They don't shut down their mines because they need the forex. So gold mines would be the last thing that should ever shut down. I can't speak for Russia or Ukraine at the moment, but one thing I would say is that I would far rather be drilling in Africa at the moment than I would in certain parts of Europe. So, this whole political risk argument with West Africa, look, at the end of the day, West Africa, actually, if you add up the production profile of the main countries that we operate in, the production actually exceeds Australia's production. It actually, if we were to take the production of Ghana, Burkina Faso, Ivory Coast, Mali, add them all together, it would be the second largest producer in the world behind China and above Australia. So the whole, political risk argument, in 25 years, we've never lost a rig. We've never stopped drilling through a coup d'etat. So it's, there's 54 countries out here, and at any point in time, someone's going to be having their political issues, but they never stop mining. Never stop mining, they never stop drilling.
Excellent. So I have one question left, and then I would invite questions from the audience. And that is about your social activities. can you talk a little bit about that, what you do on that front?
Our ESG agenda?
Yeah.
Yeah, ESG agenda is something that we take very seriously. Geodrill is leading the way out here. We've taken, of the 17 UN sustainable goals, we've taken 8 that we want to focus on in our agenda. We don't believe that it makes any sense to try and get a bronze medal for 17 of the goals, so we'd rather go for gold medals with 8 of the sustainable goals. And they include things like no poverty, gender diversity, how we deal with recycling, waste plastic, fair pay. The environment is obviously a very big one. I would invite your audience to check out our website, and we have a link. It's called the ESG link, obviously, but within the ESG link, there's the ESG stories. And I don't think a week goes by where we're not doing something that's not either community, environmental, or something related. Just yesterday, I was on a panel for the Australian High Commission in Accra, Ghana, where we were discussing women in mining and how we're looking at rolling out traineeships for female drillers. This would be a first for Ghana. And that's part of our diversity agenda. We're also an equal opportunity employer. Our gender diversity is increasing every year. Currently, of the 1,100 employees in the company, 87 are female. You might say that that's not worthy of a gold medal, but 5 years ago we had 0. So it's improving, and you've got to also appreciate that we have cultural barriers out here, a little bit different to operating in the Western world, and also that the very nature of drilling, it's a bit rip, tear, bust. It's not, the sort of thing that you would consider a traditional role for a female, but that's changing. Okay, let's wind the clock back a week before that. We recently were involved in a very interesting project where we took recycled plastic and converted it into an eco-friendly bus shelter. And this caught the attention of the BBC. And again, if you visit our website, you'll see that there's a story. Geodrill launches first eco-friendly bus shelter in Ghana. This is if you can imagine, plastic bottles. What happens to them? They wash up on the beach here. So we collect them, we recycle them, and we make beams, 4x2 beams, which essentially look the same as timber beams. And we built a bus shelter. And on that bus shelter, we put solar panels. And so folks that used to stand in the hot sun waiting for a bus to come can now sit down comfortably in a bus shelter made completely from recycled plastic. And if their phone needs a charge, they can plug that in and get some charge while they're waiting for a bus. That's just one of our projects. As I say, I think you really need to jump on to our website and just check out the stories. How we look after our employees here. Wind the clock back another month or so. One of our employees was sick, needed a kidney transplant. We flew him out to another country to have a kidney transplant. In West Africa, people just do not normally look after their people like this. So ESG is something that it's something I'm extremely passionate about. I can go on and on and on for hours about it, but in the interests of brevity, I think the best thing I would suggest that your viewers do is just visit our website and just go straight to ESG stories, and there you'll read a lot of heartwarming stories about great stuff that we're doing in the community, in the environment, and just in general.
Yeah, I would definitely agree that people check out the website. I spent a lot of time there. It's quite nice to read about what is going on there. Yeah, I very much appreciate that. So if somebody from the audience has any question, now would be a time to ask.
Actually, just looking here, we've got, we might have some questions coming. Please start.
Yeah, I don't think the chat is relevant.
Oh, okay.
It's not, and I'm not eating.
I was thinking about eating on camera or something. I'm looking at that. I'm not eating. I don't know.
So,
Anyway,
Dave, this is Brian Robson. Can you hear me okay?
hey, Brian. How you doing?
Good, thanks. So firstly, congratulations on what you've been able to build.
Thank you.
I have, gone through your information on a rather detailed basis. I've watched several videos. So I feel like I'm fairly well versed on things, and I'm very impressed. And I know that you guys, well exceeded your guidance for calendar year 21, but I was actually, I guess, expecting a little bit more in the fourth quarter. Maybe you can kind of help. I understand the seasonality aspects of it, and just looking at things on a year-over-year basis, your first three quarters were, over 40% growth on a year-over-year basis. Was there something that was in the prior year that essentially resulted in your growth not being as significant for the fourth quarter? So I've got it as just an 8% growth on the fourth quarter, and I guess I was expecting a bit more.
Sure. So, in order to understand how we fared in 2021, I don't have the benefit of having the slide here, but if I could just show you the 4 quarters, and actually we have a slide with 5 quarters, unfortunately not in this particular deck. Let me just run you through them. So essentially in 2020, quarter 4, we had a 70% year-over-year increase. Okay, it was massive. Am I correct about that? One was 38% year-over-year, one was 70. I believe it was one or the other, but it was a very, very, it was our strongest quarter 4 in the history of the company. And if you recall what had happened in the previous quarter, it was in June of 2020, gold peaked at $2,083, and there was a lot of money raised. And what was going on at that time? Do you recall? It was COVID. Okay, and during COVID, folks were raising money, but not being able to get on their planes from North America or Australia to their projects in West Africa. And so whilst people wanted to drill, they couldn't. So I would summarize this by saying we had, as we exited towards the end of 2020, we had this enormous pent-up demand. And that resulted, as I say, in a record quarter 4, 2020. As we entered 2021, the run rate increased. We didn't actually shut down for the normal Christmas, December holiday season. We actually drilled through. And so we had an extremely strong quarter 1. We drilled, we delivered about $30.7 million in revenue. As we entered quarter 2, things were starting to plateau. We actually plateaued at the end of March. By April, we were flat, and by May, June, we were coming off. As what happens out here is we enter the wet season in June. Okay, that's traditionally our slow season. So the end of June through July and September generally tend to be our slower months. And what happened in quarter 4 of 2021 was the wet season extended slightly, and we didn't really get out into the field until about mid-October. And so we had a short window. And then, of course, when we reached December, we things normalized and we had a normal sort of a Christmas shutdown. So we really, I would describe our quarter four 2021 as being 2 solid months and a half a month of entering and a half a month as we exited as being slower than expected. But it was still an 8% year-over-year increase on what was our strongest ever quarter four in the history of the company. Mm-hmm. So I actually think it was a good result, and margin-wise, we did good. Look, the end result was, the end of the year, we generated $115 million US. That was a, you know, percent year-over-year increase, 38% year-over-year increase, which was very significant, 40% year-over-year increase. So I would just encourage your viewers not to dwell on quarters, because there's things out here like seasonality we have no control over. Look at the big picture. What did we do over the course of the year? A 40% year-over-year increase in revenue, 55% in EBITDA, and 88% in net earnings. What are we going to do this year? Well, it won't be 40% year-over-year, I can assure you. It'll be more normalized. We'll consolidate. You know, I see 2022 as being a year of consolidation as we get some of these new big contracts started, and then we'll take off again. The trick for us will be to grow that revenue base. This year, at this point in time, conservatively, we've pucked in $32 million. That's about a 12.5%, 13% increase. And I think where we'll end up at the end of the year is we'll do 25% EBITDA and probably 10% net earnings.
Do you know what the consensus is for revenue for you this next year?
I haven't had a chance to actually read what analysts have actually come up with. I don't know. We only put out our numbers on Monday. We've been pretty busy fielding various calls. Some analysts have started to send through their reports. From what I've seen, they look okay. I think I've seen a 129. I saw a 132. I saw a 130. I think that's conservative. And I think halfway through the year, we'll get a better sense of where we're going. What I can tell you at this point in time is, even though that's my conservative number, things are really ramping up. Things are really ramping up. We had a slow January, and that was because we've just got all this organizational stuff that we're doing before we get the rigs out into the field. When we sign contracts, you know, you don't sign a contract and start drilling the next day. There's training and there's mobilization and organizational things that go into drilling. So January year over year was slow. February was a slight improvement. March is extremely strong. But the result being is that what your investors and your audience can look forward to this year is a flat quarter one year over year, just to give you a heads up on that. Now, quarter two will be very strong. So this is where 2022 and 2021 will be different. Now, this is actually normal. What actually normally happens is that quarter two is stronger than our quarter one. Last year was a little different. It was our quarter one was stronger than our quarter two, and we spent the rest of the year explaining why, when in fact it was very simple. We just had pent up demand at the tail end of 2020. This year will be more normal. We'll have a strong Q1, but it'll be flat year over year, probably a slight bump. Quarter two will be very strong. The plateau, our revenues will plateau probably closer to June, whereas they plateaued in March last year. Our quarter four will be good. It'll be a good, solid year over year improvement, and our quarter four will be solid. So that's how the year is going to play out. High level, this point in time, I think you can plug in a 12 to 15% year over year increase, and you're going to see that 25% margin based on that increased revenue number. And that's conservative. You know, I always like to underpromise. I never, you know, there's nothing more difficult than trying to, you know, when you're halfway through a quarter, realizing you're going to be a mess. So I always like to make sure we don't read that word miss if we can avoid it.
And then Did I hear you right when you were talking in terms of multiples that you were saying 4 or 4.5?
I think I was talking about valuation.
Okay.
So I was talking about value. Basically, what I was saying is that, and I think the discussion that we were having there was in the context of potential M&A. And M&A at this point in time for us doesn't make sense because we really only trade at a 3x multiple, and we need to move that needle before we would consider any M&A with anyone. But therein lies the deep value in this story for your investors. This is a stock that generates north of $100 million and 30 plus $1 million in EBITDA, or will this year, and we trade at a book value slightly. We trade. Our net tangible book value is essentially our share price. I think we traded at a 10% premium.
Anything new in terms of that Burkina Faso tax exposure?
That one is a conversation that just seems to keep lingering. We do not owe the Burkina Faso any tax. We paid our tax. We paid more than our tax. They want us to pay our tax again. It makes absolutely no sense. Legal systems looked and said this is nothing more than an opportunity suite, and it's going nowhere. And I think the Burkina Faso government has egg on their face, and they're trying to figure out how they save face. Our auditors, PwC, telling us this is going nowhere. It's absolutely going nowhere. So, look, I think it's going to die. I think it's going to die a natural death. Just coming back to valuation there just for a second, I'm not sure whether we touched on it before. Valuation-wise, the stock's done pretty well. But as I say, in the last 3 years, on average, our earnings per share has increased by 77%, yet our share price has increased only 23% per annum. So our share price has moved. It's done well. It's up like 50% this year. But so's our operational performance. So it hasn't actually even yet moved in lockstep. The stock is actually cheaper than it's ever been on a relative basis. That's the point that I was making.
I'm going to quote you, and you may have said this in your opening remarks. I'm sorry, I joined a little bit late, but in a previous presentation, you actually said that in the last upcycle, you traded at a 6.5 to 7 multiple. Yeah, do I have that right?
Yeah, I'll actually go back to that. This is the slide. So the average that you're looking at there is 4 to 5.
Yeah.
But the peak is about 8, I believe.
Okay.
So I'm happy. You have the slide in your deck, and I can't zoom in there, but I believe that.
It's between 8 and 9 at the high point.
At the peak. Yeah. So I don't think I was off with I don't think I was at all out with my statement.
Okay.
Yeah. And so if the stock currently trades at 3, and we're, as I say, in the early stages of an upcycle, I think therein lies, the value case for the story. Drillers. The drilling space tends to trade in a range of 6 to 15 times in an upcycle. So I read an analyst report the other day where they were quoting another driller, a larger driller, a North American mineral driller, and currently trading at 8.5 times. And they were saying that the valuation should be more like 15 times. I don't know. I wouldn't mind a bit of that. So I think you can safely say that the 3 is, you know, we're the diamond in the rough. You know, we are the absolutely overlooked driller. And people look at our share price and say, oh, it's moved, I've missed it. We still trade at 3 times EBITDA. So just look at your price earnings ratio. Some of the drillers that you'll check don't even have a price earnings ratio because they're only just starting to become net earnings positive. Geodrill has been operating cash flow positive since 2016. And since 2016, we have been reinvesting our cash generated from operations into the business. And this is how we've grown the business. And as a result, our revenues have grown, EBITDA has grown. And so whilst the valuation has improved, so too has our operational performance. And so on a relative EBITDA multiple basis, the point that I'm making is that we're as cheap today as we've ever been.
And on top of that, you have net cash. And then if you consider your reputation, your relationships, I mean, it's for any acquirer, it will be a no-brainer deal.
Right, really. Florian, I'm going to actually email you after the call. One of the banks cover us, which is probably going to be the most recognized to you, which is TD. And in there, they do the most comprehensive comparable to the other drillers. And on an EBITDA for this year, we're trading in, again, sorry, I don't have it open right in front of me, but I believe it's around 3 times, where our average industry is trading at over 6.
Yeah.
We're cheap, but I'll send it to you.
On a TTM, Joe, we trade at 3.2, and on a go forward, we trade at about 2.9.
Speaking of trading, have you considered doing something about your American listing?
I'm going to hand you over to Joanna. I believe something's happening there. I don't know. Joe? I mean, we have an OTC. We have an OTC listing,
about
right?
This. Yeah, we talked about this in that we have an OTC listing, which isn't something we actively do. I'm not sure if you're aware of this, but if there's a broker in the US that wants to trade our stock, they can basically do the trade and put us onto the bulletin boards, right? Like that, it's not us actually making that happen. Anything more, we would then have to convert IFRS, which, you know, at this point, the CFO is not thinking it. To be honest, like, I mean, would that attract more buyers? I mean, we already have both institutional and retail guys out of the US that are happy to buy us on the TSX. There's no issue there. And I really don't think that Geodrill is going to be around, no offense, Dave, but I mean, I think in this upturn, we're going to get taken out in the next 2 weeks. 2 years, sorry, 2 years.
I'll take the 2 weeks.
So, I mean, by the time we would go through that process, do you know what I mean? Like, why?
Yeah, I see your point for sure.
Like, honestly, I could see that in the next 9 months, we might be in protracted talks. So that listing is probably not a best use of our resources.
Excellent point. Yeah.
Do you know what? We haven't even discussed the dividend. We paid a 2-cent dividend last year. Did you see we announced a 6-cent dividend this year?
Yeah, I saw that. I
thought you might have mentioned it actually. So I mean that kind of puts us at about a 2.2% yield. That's kind of above what even some of the royalty companies are paying. This is a drilling business that would normally, you know, be focusing on all its efforts into, you know, putting the cash back into the business. But we've been doing this now for 12 years since going public, 25 years since we started operations. So it's time. And if we can't get, you know, the needle to move for our investors in the share price, then what better way to do it than reward them with dividends? And I think the dividend was you know, it's a respectable yield, and it's a good use of our cash. And hey, we're the only North American exploration driller that are actually paying dividends. You can buy an $8 share in, you know, Major. You won't get a dividend. They haven't paid dividends for years. What we're attempting to do here, and I believe we will be successful, is to be the drilling company that pays dividends in a down cycle. We could have been paying dividends a long time ago, but we decided to keep putting our cash generated from operations back into the rig fleet. Where we're at today is we don't have debt. We will enter the next down cycle in 5 or 6 years' time in pretty good shape. And we will be profitable through the down cycle. We were profitable through the last down cycle. We will become the drilling company for all seasons. If we last that long. I think the more likely scenario here is that someone's going to come along with a big fat checkbook. The bigger the fatter, the better, I would suggest, and just take us out. Because, you know, we are an absolute thorn in the side to some of our competitors, and you know, they can't make money really with us in their market. They cannot. We can. That's the Geodrill X factor.
Very good. Brian, do you have anything else to ask? I think he said no.
I did say no.
Thank you for setting this up by Geodrill.
Yeah.
It's cheap.
Well, it's great to have you on. Thanks for the presentation. Thanks for answering all our questions.
Some or all the speakers may maintain positions in the securities discussed in this podcast. The views in this podcast expressed are those of the speakers and not breakout investors. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. Neither Breakout Investors nor any of its affiliates makes any representation or warranty, express or implied, as to the accuracy or completeness of the statements or any information presented by this podcast and any liability, including in respect of direct, indirect, or consequential loss or damage, therefore is expressly disclaimed. No one on this podcast is an investment advisor, and no one is providing investment advice. Before investing in any company's stock, you must do your own research. Thank you for listening.